I bought a 29 unit apartment complex a couple years ago and it is absolutely bleeding cash. I want to be real and vulnerable with you here on this video. It's actually been the worst investment I've ever made. So in this video, I want to talk about how I bought it, how I structured it, how it was supposed to go, what's actually happened, and my plans to fix it. If you're into people being real and telling you what actually happens, hit that like button. So I bought this 29 unit apartment complex about 2 years ago. It's a mixture of 3 bedrooms, 2 bedrooms, 1 bedrooms, and studios. It's a really cool building in a nice area of town. This is how I was able to buy it using none of my own money. I'm not gonna get too technical here. I am gonna show you all the numbers, but I wanna talk about the main concepts, the screw ups, and the changes and fixes more than the nitty gritty numbers. I ended up buying it for $3.65 million. I got a 20% loan from 2 private lenders that I've used in the past. So they gave me $730,000 total for the 20% down payment. And then I financed the other 80% with a small local bank that I'd used in the past for a loan about $2.92 million. Quick tip, notice I used people I had used in the past. People want to get into apartment complexes because it's sexy and it's cool and the numbers are big. However, you're more likely to be successful if you start out with single families, prove yourself to the banks, prove yourself to the private lenders, and then you can graduate and up their investment and up the length of their investment by doing longer term, bigger projects. The goal was for the properties to cash flow around $50 to $100 per month per door from day one. I know that doesn't sound like a ton of money, but I am financing 100% of the purchase price. I'm using none of my own money and putting none of my own money down. Now the property did appraise for a couple $100,000 more than we bought it for, so there was some equity built in. So over the next 3 years, all 29 units would eventually be getting $100 to $200 more cash flow per month, which would put us in that $200 to $300 range. If I succeeded in doing that 3 years from purchase price, I would have created enough equity to do a refinance and pay back my private lender. But that is not what happened, and that's why I'm shooting this video. So here's what went wrong. We ran our pro forma statement at 95% occupancy, what we thought we were going to get. We thought that was pretty conservative, leaving 5% in there. However, within a year of us buying the property, there was a couple brand new apartment complexes that were built with more amenities. Our apartment complex does have private parking, it does have a gym in it, but it does not have a pool or a coffee shop or things that the property that was built next to us has. And they're not charging that much more rent than we're charging because they have bigger properties, more scale, so that really hurt our occupancy. So we're currently sitting at about 92% occupancy, which absolutely crushes our overall net income. Let me show you some numbers and explain why that 3% is such a big deal. For simplicity purposes, in this example, let's say that we get $1,000 per unit. So that means if we're 100% occupied, we're collecting $29,000 every single month in rent. And we ran the numbers at 95% occupancy. So 95% of full occupancy of $29,000 is $27,550. However, we're currently sitting at 92%. Some of the time it's been around 90%, but the difference in that is 92% of 29,000 is 26,680. So the difference between those two is $870. That may not sound like a lot, but apartment complexes' value is based on the net income that they produce. So that may not sound like a lot, but $870 a month times 12 months is well over $10,000 of income that goes to the bottom line because our expenses are fixed that we're not getting. That in itself has really slowed down the increase in value that we need to refinance and has therefore lengthened the time and the loan that we've had with our lenders. The second issue that I kind of already alluded to is there has been some apartment complexes recently built in the area that are charging similar rent to us, but they are brand new. As you can see by the pictures that have been popping up, our building is very nice. However, the buildings that have been built are brand new with more amenities and they are attracting people to them, and they are several hundred units big. They're like a own little complex, so our little dinky 29 unit next to them doesn't look as attractive to potential tenants. Now we've had to adjust our prices a little bit to try to lure people over, but we can't go too low or we're not gonna actually cash flow. And we built in some rent increases that we're simply not able to get right now. The third issue that's kind of been out of our control has been interest rates. We didn't know that interest rates were going to go up as quickly as they have. We're locked in for a while on our interest rates, but interest rates do affect the cap rate, which does affect the value of our property. So we bought the property at about a 6% cap rate because it's in a pretty good area, but currently that area is probably more like a 7% cap rate. I don't want to get into cap rate, but in general, just know the higher the cap rate, the less valuable your building is. Those three factors combined have really stopped us from going from that $50 per door that we were at to that $200 per door that we needed. Plus, another big issue that we've had recently was there was a shooting in the building. It wasn't a mass shooting, it was a tenant and a friend, or I guess former friend, arguing, and one of them shot the other one in the leg in the hallway. So naturally, that scared a lot of people. A couple of people didn't renew their lease, and that has not helped our occupancy. Even though they were approved tenants in a good area, people do dumb stuff. All right, enough of the pity party. I cannot control what happens to a certain extent, but what I can do is control how I react to those things. So this is how we're reacting to get everything back on track, to get this building into the shape it needs to be to refinance and be a good cash flowing asset. If you appreciate this transparency and this realism, make sure to like this video, subscribe to this channel, and comment below that you appreciate somebody being actually real on social media and not fake. We are implementing a newer strategy that has kind of just become popular over the past 6 to 12 months, and that is called midterm rentals. Midterm rentals are renting out your units on a 3, 6, or 9-month basis to traveling nurses or corporate leases, people that need to live for an extended period of time but don't want to live in a hotel and don't want to sign a 12-month lease. And you would be shocked at the demand versus supply when it comes to these types of tenant bases. There are about 2 million traveling nurses in the country, and if you go to Furnish Finder, which is the #1 source that traveling nurses go to actually get these leases, you will see that there are about 200,000 units available. Demand of 2 million, 200,000 available. That means you own or you have what is in big demand and the supply is super, super low. That's good for us. That means we can charge more rent. Plus, these traveling nurses tend to get stipends and they're not super worried about what the rent is. They just want somewhere close to a hospital. And fortunately for us, this property is very, very close to a couple different hospitals. So we are implementing this midterm rental strategy to help increase cash flow. For example, we have a studio unit that's kind of hard to rent that rents for around $950 a month. And running our formula, that thing cash flows about $50 a month if it's actually rented. We spent a couple grand furnishing it, so not a ton of money out of pocket, and we put it on Furnish Finder for $19.50 a month, so over double the rent that we were searching for. Now, there are a few more management expenses when it comes to having a tenant move out every 3 to 6 months. There's a little bit of furniture we put in it, but we went from cash flowing net $50 a month to cash flowing $500 per month. We've done that on 2 separate units and we've got them filled very quickly. So we are intermixing some midterm rentals and actually some short-term rentals as well. You can kind of go between the two because they're both furnished units. We have done that over the past couple months and that has really helped increase the net income, which will therefore increase the value of the building. Now we have to do this for a couple different years. We're probably going to get 5 to 7 of these over the next couple years. That should increase our net income enough running the pro forma that we had, even at that 92 to 95% occupancy range, so that we're able to create enough equity, pull that equity out, pay back our private money, their lender plus interest, and own this unit that cash flows. Hopefully in the next couple years, interest rates will go down a little bit, which will increase that cap rate we talked about a little bit, which increases the value very quickly. And it will also allow us to refinance at a rate that is manageable and it will allow us to cash flow. So our 3-year plan went to a 5-year plan. The beautiful thing about real estate and being creative is using what the market gives you, using midterm rentals, using new strategies that come out there all the time that other creative investors are utilizing to maximize each asset. If you'd like to learn how to start buying real estate, single family rentals, or apartment complexes, make sure to subscribe to this channel, like this video, and share this with a friend. We host our podcast on this channel as well. I am intermixing some of these very, very educational videos into the podcast. So make sure to subscribe, hit the notification bell, because we do 2 podcasts a week on this channel, but I'm also going to be giving educational videos like this that can help you learn as much as you can in your limited spare time. I appreciate you for being here. See you on the podcast.